Welcome everyone! Thanks for joining another chapter of the Financial Independentist. Today, we're gonna do a deep dive in American Express business, their financials, and their most recent earnings report. We will take a look at how the company makes money, whether it's recurrent or not, and we'll make a qualitative assessment on whether this is a good company to have in your portfolio. Then, I'll share my valuation model for the company and we'll discuss if the stock is a good buy or not at today's prices. American Express operates a closed-loop payments network, serving as both card issuer and transaction processor. Its core business focuses on premium credit and charge cards for high-spending consumers and global businesses. The company follows a spend-centric model, driving volume through exclusive perks, travel benefits, and a strong rewards program. They generate significant revenue from merchant discount fees, annual card fees, and interest margin from customer loans. American Express is a large corporation trading at a market cap of around $250 billion, with over $65 billion in revenue for the last 12 months, gross margin of 64%, and net income margin of 16%. The stock has been performing quite well in the last couple of years, following a market re-rate, which as we will discuss later, is very well deserved, from a multiple of 15 times earnings to around 21 times forward earnings as of today. Part of this rally is fueled by the market finally understanding that their card business is really an equivalent to other subscription-based businesses, wherein customers pay every year for the right to hold and use an American Express card, and all that represents: prestige, high credit limit, even unlimited, and perks, a lot of perks, that make being a customer an entire premium experience. We will go over all of these in today's video. But before that, let me share a quick reminder that just a few days ago, we published a video analyzing the current situation of Nike, their financials, and the strategy that the new CEO, Elliot Hill, is setting up for the company. This has been a very good performing video in this channel so far, so I'd recommend you check it out. Link in the description below. And by the way, if you like this content, please make sure to hit the like button and subscribe right now. It really helps the channel grow and you'll even get better content in the future. Please also leave some comments below regarding American Express, whether you own shares, and if you're bullish on the company. Alright, let's get started. In the recent earnings release, American Express reported record revenue of $18.4 billion, growing at 11% year-on-year, an EPS of $4.14, up 19% year-on-year. Very solid numbers. In addition, fiscal 25 guidance was raised to a revenue growth of 9% to 10% for the year, with EPS in the range of $15.20 to $15.50 per share. Looking at the numbers, we see that all metrics are in green. Revenue for the quarter up 11%. Revenue from Q1 to Q3 this year of $53.2 billion, up 9%. Looking at the bottom line, we have net income of $2.9 billion in the quarter, up 16%. Here we see important operating leverage, as for every incremental dollar in revenue the company generates, more percentage of it is transformed into net income. In other words, net income grows faster than the revenue. EPS of $4.14, up 19% for the quarter, and $11.95 from Q1 to Q3 this year. Here we see a clear acceleration in this last quarter versus previous. Why that happens? Two components. First, operating leverage, as we observed before. Second, reduction in the total number of shares outstanding, which as of this last quarter ended up under 700 million. Let's take a look at the revenue numbers. While American Express business model is built on top of their main platform, the card, it is quite diversified in the backend. First, we have discount revenue of $9.4 billion in the quarter, up 7%. This is a percentage of the transaction amount that a merchant pays to American Express for accepting the card as a form of payment. In other words, American Express has a call option on all expenses their cardholders make with the card. This is an insane business model, highly scalable and profitable. This segment is dependent on how well the economy is doing. The more dynamic it is, the more transactions there will be, which means more payments received. The company's baseline estimate follows a trend of the last couple of years, with an expected US unemployment rate of under 5% and US GDP growth moving towards 2%. In addition, they also supply a downside scenario, which in my opinion is quite pessimistic, with all macro metrics substantially deteriorating. I find this scenario highly improbable, but it is good to see that management considers such scenarios in their daily decision making. The company has been reporting a stable number of transactions and payments received over the last number of quarters, with growth in the 6 to 8% range. This is representative of a functional economy wherein the company continues doing business at a good pace. Second, we have net card fees of $2.5 billion, up 18% year-on-year, which is really outstanding. The company charges an annual fee to its customers for the right to hold and use American Express proprietary credit and charge cards. In this last quarter, American Express has scored 3.2 million net new cards acquired, a number that is consistent with previous quarters. This represents the number of new users of their main platform. 3.2 million in just one quarter is quite a strong number. The total net card fees for the quarter was $2.6 billion, up 17% year-on-year, and growing strong. To put it short, every quarter there is a larger customer base spending more money with the card and paying more fees. Fees are essentially a recurrent revenue stream. They provide a stable, predictable, and high-margin revenue source, often referred to as subscription-like income. These fees vary significantly based on the type of card, and they give access to a different set of benefits across many different categories like goods, services, travel, and entertainment. There are two main types of cards: credit cards and charge cards. American Express is well known for the charge cards, whose main feature is that they have no preset spending limit. The amount you can spend with these cards adapts to your financial profile, payment history, and spending patterns. This spending cap is therefore variable and can increase or decrease over time as you go building credit with the company. The Platinum card has performed exceptionally well for American Express, serving as a powerful platform for premium customer acquisition, high-value spending, and robust fee-based revenue. Platinum card users account for approximately $530 billion in annual spending globally, and lately, new US Platinum account acquisition have grown twice as fast as they did before the refresh. What's a refresh? Essentially an update on premium card benefits. American Express strategy aims to attract high-spending customers to its premium fee-based products, like the Platinum and Gold cards, which have higher annual fees. These users generally also have much better credit scores, which essentially means lower delinquency rate and therefore credit losses. In addition, card fees for these users can be increased over time with minimum churn. Third, we have service fees and other revenue of $1.97 billion, up 18% year-on-year. This revenue component groups all other revenue generated from other sources like foreign currency-related revenue, delinquency fees, travel commission and fees, merchant service fees, income from investments, and other miscellaneous fees. While these other sources of revenue look disaggregated and not necessarily recurring by themselves, the reality is that they are as a whole a relatively stable source of revenue. And finally, the company scored net interest income revenue of almost $4.5 billion, up 12% year-on-year. This is basically the interest arbitration between money loaned to American Express cardholders via credit and the actual cost of money. Growth on this segment has been consistent over the last few quarters, which reflects a stable customer base. American Express customers have above average credit score, generally quite good, which makes the cost of capital lower, so the arbitration margin the company generates is significant. If we take a look at the top-bottom fundamentals, we see that revenue has been increasing steadily year after year, with just a small dip on 2020 due to the pandemic. Since 2015, that is 10 years ago until now, revenue has more than doubled, from $30 billion to $65 billion. Next, gross profit has also been steadily growing over time. Although we see a slight margin compression from upper 57% back in the day to slightly below 51% as of today, this is not a big concern, but it's something management should take a look into. Finally, the bottom line also shows high consistency. We also see some compressions on the bottom line margins, which seems related to what we observe with the gross margin. But overall, the company is extremely profitable, with net margin of 16% and generating over $10 billion of net income every year. This is a predictable and recurrent cash-generating machine. Now, taking a look at the company's capital return, a good portion, about 72% of the net income, is returned to shareholders via dividends and share buybacks. The company has been aggressively buying its own shares at a pace of a 3.6% CAGR over the last years, and has reduced the total outstanding below 700 million. Each share today represents a 30% more ownership of the company than 10 years ago. This is compounded growth at play. In addition, the company pays about a 1% dividend yield. Sure, it's not a high-yield dividend company, but it's growing quite fast, up 58% in the last 3 years. I know some dividend investors out there that will definitely like seeing this. In the end, more dividend means more cash to deploy in more shares, right? In addition, the company reported average return on equity of 36%, impressive, and capital tier 1 ratio of 10.5%, which is exactly in the targeted midpoint and well above the minimum requirement, so they are very well capitalized. On the free cash flow front, we have another confirmation that the company is a money printing machine, with almost $19 billion in the last 12 months, and capital outflows of $8 billion when adding dividends and buybacks, which means the company has retained almost $11 billion in their balance sheet. With respect to valuation, the company has appreciated in the last couple of years, with a re-rate from around 14 times earnings to 21.5 multiple as of today. Does this mean the company is expensive today? Absolutely not. What this means is that they were extremely cheap a couple years ago. Honestly, buying a company of the quality of American Express at 14 times earnings was simply ridiculous, and I was one of the lucky investors that grabbed a bunch of shares back then. I don't know what the market was thinking at that time, but this is yet another example of market inefficiency. Simply put, American Express is at minimum fairly valued as of today, if not still undervalued. For example, if we compare it with the likes of Visa or MasterCard, we see that there is still a wide gap in premium the market is paying for these two versus American Express. True, their business models are not exactly the same, but there are reasonable similarities between them that should lead to a smaller valuation gap. Today we're talking about the market is paying more than a 50% extra premium for Visa or MasterCard than for American Express. I think this gap will eventually be reduced. With reasonably conservative inputs of 12 months revenue of $65 billion, growing at a 5-year CAGR of 8.5%, which is lower than today, net profit margin of 16%, same as today, earnings multiple of 24, which means slightly higher than current, as we discussed before, 693 million shares outstanding and reducing about 2% every year, which is more conservative than today. When applying a 10% discount rate, I get a fair value of $373 per share, which is slightly above the market price of $359 as of today, representing a margin of safety of around 4.3%. You could argue that there is not enough margin of safety today. I could argue the company is more than fairly valued. Either way, it is a buy at this valuation in my opinion, given the quality of the underlying business. Okay, so what's my game plan with American Express? Considering the investment thesis presented in this video, we have American Express rated as a AA company. That's a premium level investment in which we are extremely confident for the long term. There are not many businesses out there that are better than American Express, so the stakes are very high for this company. For that reason, we currently have around 1.7% of the fund deployed in American Express, remain bullish in the company, and willing to keep adding shares every time we see a price pullback, which to be honest, doesn't happen very often. In this regard, a good entry point could be under $335 per share, once we secure at least a 10% margin of safety. But how about you? Do you think American Express is a good company to add to your portfolio? Leave your comment below and we can discuss about it. Alright, that's all for today. Just a quick reminder that this content is not financial advice. Please do let me know in the comment section below if you have American Express stock or you have plans to starting a position, and don't forget to like and subscribe. It helps us a lot in providing better and better content. Thank you very much for watching. See you all in the next episode.